We're going to focus on the use of futures and options on bonds to hedge against interest rate movements for a financial institution. First, we're going to talk about using futures for this purpose. We're going to, in the end, solve for the number of futures contracts financial institutions should purchase in order to hedge against interest rate movements. Now, recall that the change in the market value of a financial institution's equity from a change in interest rates is this formula. We have minus the leveraged duration gap times the assets, and change in the interest rates over 1 plus the interest rate. Now I'm going to label the interest rate A here for assets, say that this is the change in the interest rate and current interest rate for the assets of the bank. And now we're going to talk about the change in the value of a futures contract. So we're going to define NF as the number of futures contracts and PF as the price of a futures contract. Therefore, the value of the whole position will be the number of contracts times the price per contract. So the change in the value of the futures contract using the duration approximation method be negative duration of the futures contract times the original value of the futures contract delta R over 1 plus R, the interest rate. And here I'm going to qualify the R's with subscript F to mean the change in the interest rate of the underlying bond of the futures contract. And do one more step here where I plug in the formula for F, because the value of the futures contract are the number of contracts, or so the value of the whole position, number of the futures contracts times the price futures contracts, and then the relative change in interest rates. So in order to fully hedge the interest rate because of interest rate changes, we would need to have a futures position that would fully offset it so that the change in the equity value plus the change in the futures position would equal 0. If we plug in the formulas that we had written out above and then use that to solve for NF, we'll have the number of futures contracts the bank should have. Now, if I rearrange that, that means that the delta E should equal to the negative of the delta F. So that means we have this. Now, if we assume that these relative changes in the on-balance sheet items and the futures contracts are the same, just writing that out formally, then that means that we can cancel out these two terms because they're equal to each other. And we would have this formula for the number of futures contracts. So we're going to bring everything over except for the NF to the other side. We'll have negative of the leveraged duration gap divided by the duration of the futures contract and the price per futures contract. And so this would be the formula. Now, what does it mean to have negative contracts? So a negative number of futures contracts means the financial institution should take the short position, which means they will be selling, they will sell bonds at the futures price. Note that this strategy will completely immunize the portfolio against changes in the interest rate if, there's a big if, the movements in the financial institution's portfolio and the bonds underlying the futures contract is perfectly correlated. And recall from the things that we looked at in our live class, we saw that there were only certain types of futures contracts that would deliver certain kinds of bonds. We saw 2-year bonds, 5-year bonds, 10-year bonds, and then even in the category that was called 10-year bonds, there was uncertainty as to even which kind of bond was going to be delivered. And so because we know that interest rates in actuality don't always move uniformly, and the yield curve could change its amount of steepness, it would make sense to not always make the assumption that we made here, that the changes, the relative changes in the two are the same. So if we assume that there's not a one-for-one change, but that there's a tendency for the futures or the bonds underlying the futures contracts tend to go up or down by more or less than the interest rates of the that's on the bank's balance sheet, then we have what's called basis risk. And the basis risk measure basically says this is how much the change tends to be. So how much the change in the balance sheet rates tend to change with the rates on the bonds that underlie the futures contract. Now, if we assume that, we can't cancel out those relative changes anymore. And we would get this term. And I'll leave it to you to work that out from the previous proof. But as you can see, it looks a lot like the assumption without basis risk. Essentially, without basis risk, we're assuming this BR term is 1.0. Now notice that if the bank's leverage duration graph is positive, it should take, which is the long or short position, remember what I said earlier? They should take the short position, because we can see that if this number is positive, then this number will be negative. Okay. Right? If that's positive, this is going to be negative because you have the minus sign. And therefore you'll be taking the short position. All right, well, let's use the formula that I've developed here to answer the question. We have a financial institution with assets of $250 million. So let's just start writing the information down as we see it. liabilities of $200 million. And let's just go ahead and calculate that leverage ratio. So remember, that's that's liabilities over assets. So 200 over 250, the leverage ratio is 0.8. And then we see the duration of the assets is 6 years. The duration of the liabilities is 3 years. And we are told that the price of the futures contract is $115,000, and the duration of the bonds underlying the futures contract is 5.5 years. All right, so that's all the given information. Now let's use, and also basis risk is 1.1. So the question is, what's the number of futures contracts? So that means we want to know what's the NF. Well, we're just going to plug the numbers into the formula that I developed up here. So we have negative duration of the assets minus the leverage ratio times the duration of the liabilities, value of the assets, basis risk. So this means that the assets the interest rate on the balance sheet tend to go up by 10% more than the change in the interest rate, the relative interest rate of the bonds underlying the futures contract. And then we have in the denominator, we have the duration of the futures contract, 5.5, I'm sorry, and yeah, 5.5, and the price. And since I have millions here, I need to make sure that these are in millions, so I'll put in 0.115 million. We'll put that into the calculator, and we get negative 990 divided by 0.6325, and that gives us an answer of negative 1,565.22. So this means, because we have negative, that we're going to sell 1,565, because you can't do a fraction of a contract, futures contracts. Now the second question is, what's the number if there is no basis risk? In other words, there's a one-for-one correspondence between changes in the underlying bonds interest rate and the bank's balance sheets interest rates. Well, if the basis risk is 1.0, then we just don't have that BR term here anymore. So implicitly, the basis risk is 1.0, and we would get negative 1,422.92, or in other words, sell 1,423 futures contracts. So we see that the one thing to note here is that when we assume some basis risk, we had to buy more futures contracts, or actually sell more futures contracts. Interest rate movements, particularly interest rates going up. Just one more comment about the intuition of why the bank will be selling futures contracts is that, remember, the risk for FI is that interest rates will go up. And so therefore, it wants a futures contract to have a positive payoff when interest rates go up. So then think about what happens when interest rates go up. If interest rates go up, bond prices go down. And then if bond prices go down, the short position on a bond futures contract, the value of it will go up. The payoff goes up. Okay? So the payoff of the short position. All right, well now let's transition to options. Now recall, an option is like a futures contract, except the holder of the option has the option to not exercise, or in other words, to not sell or buy if it's not going to give them a positive payoff. Now, with pricing of options, the value of the option is going to be dependent on the value of the underlying asset. And in a call option where you have a right to buy, the value of the call option will go up when the underlying asset goes up. If a put option where it's the right to sell, the value of the option will go up when the underlying asset goes down. Now the statistic, or the name for really the first derivative of the price of the call or the put with respect to the underlying asset's value is called the delta. And to distinguish it from delta, which is also used for changes, we're using basically the lowercase way of writing the Greek letter delta. Now recall, a put option has this payoff structure where if, and let me define things, where X is called the exercise or strike price, meaning this is the price that you have the right to sell at, and B sub t is the bond price at, say, delivery or expiration of the contract, okay? And the expiration date will be t. We can see that if the strike price is greater than the bond price and you have a put option where you're selling something worth bt, you would definitely want to do it because you'd be getting more than what it's worth. You could buy the bond at date t at bt and then sell it with your put option. But you'd only do that if it's in your interest to do so. If it's not in your interest to do so, you don't exercise your option and your payoff would be 0. Now, if interest rates rise, then we know that the prices of underlying bonds falls. And if the price of underlying bonds falls, then, as we see here in the formula for put payoff, the put payoff rises. And so for this reason, the delta of a put option must be negative. Now let's do what we did with futures to calculate how many put contracts a bank would need to buy to hedge against interest rate movements. And again, we want to buy put options because the risk for a bank, the purpose of a put option is to hedge against falling asset values, and the assets will fall in value when interest rates rise. All right, so we're going to define the price of the put position as the number of puts times the price of a single put contract. Okay. And we're going to set up this formula again, where we want the change in the equity value plus the change in the put contract's position to be 0. Now let's, so we know the delta E, we've established that already. Let's just talk a little bit more about the delta P. So we've defined this lowercase Greek delta, remember, is the change in the value of the put contract with a change in the price of the bond. So if we have a change in the price of each bond that underlies the contract, and then we multiply it by the number of contracts, we have the change in the put position. So now let's just plug in. We've already gone over the formula for the change in the equity. And now plug in delta P. And using the duration formula, we can go further and also I'm going to bring this over to the other side. I'm going to plug in the value of the change in the bonds. So that's, first of all, we have to have the negative sign there. And I'm going to put dB as the duration of the underlying bonds of the put contract. Right, so where B is the value of the bonds of the underlying put contract. Now, if we're assuming no basis risk, then that means that these two relative changes are the same. Oh, I forgot the parentheses around that. Oh, and I forgot the NP there. Of course. So we rearrange the formula and we get this formula that looks very much like the solution for the number of futures contracts, except we have this delta term. Now if we do have basis risk, that is saying that, again, these two terms are not the same, and the basis risk is the, just remember, we're defining basis risk as how much the balance sheet's relative interest rates change with the underlying bond's interest rate. And we just get, again, a formula that looks very similar to what we've seen before, except we have this delta term. And we got the basis risk there. So that's with basis risk. All right, well, let's apply all this to an example. We have corporate bank has $840 million in assets with a duration of 12 years and liabilities of $720 million, duration of 7 years. Let's just take a moment to calculate the leverage, and instead of doing a decimal, I'm just going to reduce this into a fraction. It's going to make the calculations really easy later on. So it's 6/7. Okay, reading on, we're actually told, it's kind of a weird assumption, but it says that the yield on both assets and liability is 7.56%. So I'm just going to call it RA. And the bank is concerned about preserving its equity in the event of an increase in interest rates using a macro hedge with interest rate options. The call and put options have a delta of 0.4 and negative 0.4 respectively. Well, we've already discussed that we need a put option, because if we're concerned about interest rates going up, we want a position whose value will go up when interest rates go up. When interest rates go up, the value of bonds goes down, which makes the value of the put option go up. So we're going to use a put option, and therefore the delta will be negative 0.4, because that's the delta of the put option. The price of the underlying T-bond is $104.53125. Now, the implication is that this is per $100 par. And you just got to get used to this in finance, that a lot of bond prices are quoted per $100 or $1,000 par, and you just have to tell from the magnitude of the number which one it must be. And the duration of the bond is 8.17 years, and the interest rate of the bond is 7.56%. Right, so I'm going to need definitely much more space here. And now we're just going to plug into the formula. And we're assuming no basis risk, because it's not mentioned. So the number of put contracts, we have the leverage duration gap. So I'm just doing the 12, 7, the K is there. The assets are 840 million. Since we're assuming no basis risk, then we don't even need to know the current interest rates. And in the denominator, we have negative 0.4 as the delta. Then we have the price. Now, this is the price we're given here is 104 per 100. The question here doesn't state it, and I should tell you that we're always going to assume, unless stated otherwise, that the one put corresponds to a $100,000 bond par value. So if this is the price per 100 par, we have to multiply it by 1,000. So this means that the price of the bond would be 104,531.25 per $100,000 par. And we're going to use that number as for our P, but I have millions here, so we have to be careful. So 0.104533125 million, and we have to include the duration term of the underlying bonds, which was 8.17. that into the calculator. We have these negatives cancel out. So the numerator and denominator will be these numbers. And we get 14,753.75. Where you can't buy partial contract, so this means we buy 14,754 put contracts. Okay, the last question is, what will the cost of the hedge be if the option has a premium of 0.875 or 87 cents per $100 face value? So recall from what I had said during our live session, because an option is valuable, you have to pay for the option up front, whether or not you end up exercising the option at the expiration date. So the cost, simply the number of the puts that you're buying times the cost per put. Now remember, the put contract, one put contract is per 100,000 face value or par value. So we have to multiply this 0.875 per 100 by 1,000. So we get $875 per contract. Giving us a cost of $12,909,750. Now, let's just take a moment to compare that to the size of the bank's balance sheet. It has $840 million in assets. So the number of puts it needs to just hedge against interest rate changes would be close to $13 million. So not a small percentage of the overall balance sheet.